event of the Bank and Insurance Committee of the German-Bulgarian Chamber of Industry and Commerce and of the Belgian-Bulgaria-Luxembourg Business Club. Welcome to all of you. Thanks for this joint event. We live in strange times. 2020 was a strange year, and that strange year is still continuing, unfortunately, I would say. And it's not only because of COVID. Some of you who follow a bit the financial markets also see that financial markets are living in strange times. We have seen a very low interest rate environment already for a long time, which is quite extraordinary. And the question, of course, is how will that further evolve? But we have also seen that despite COVID, and despite the fact that COVID obviously has impacted the economic environment, stock markets as such have been quite optimistic over the past period, which also could sound a bit counterintuitive. So I thought that this were reasons enough to have a talk about the financial markets, what has been happening on the financial markets, and what could we expect going forward. So therefore, I'm very happy to have with us Tom Mermuis. Tom is Senior Investment Strategist of KBC Asset Management. Tom has a degree in business economics and has joined KBC Asset Management since 2001. He has been working for KBC Asset Management both in Dublin and in Brussels, and is currently, as I said, our senior investment strategist for the KBC Group through KBC Asset Management. Welcome, Tom. Before I hand over the floor to Tom, who will guide us through his view on the financial markets, maybe two practical elements during the meeting, I would like to ask everybody to mute himself or herself during the meeting. And in order not to overload the communication, I would also ask everybody to turn off the camera during the presentation. Last but not least, if you have questions, in order to make it practical, please, I would invite you to write your questions in the chat. At the end of Tom's presentation, we will take the time to tackle the questions. If there is not sufficient time to tackle all of them, definitely Tom will be willing to address them afterwards, and we will share his views on those questions that would not have been here today afterwards, as well as we will share the presentation of Tom after the event of this evening. So without further ado, once more, welcome to everybody, and Tom, the floor is yours.
Okay, thank you. I always feel very old when people remind me that I've been working for KBC Asset Management for 20 years, but that is exactly what I have been doing for the last 20 years, indeed. In the meantime, I shared my presentation. I think it's working well. It's always the biggest challenge to get the technology on my side, but it looks fine.
Yeah, we see your screen, Tom. That's fine.
Okay, let's go then. Like was mentioned, I work on the investment strategy for quite some time, and that's also what I brought with me. It's a number of slides because that's what we do, unfortunately. It has a very short look back on how did financial markets start the year. Then the second part is a bit more in detail on how do we look at the world today, what do we think about the COVID crisis and the economic growth and outlook, for example. And then the final part is translating those views into our current investment strategy. So pretty much how are we positioned today and what do we expect for the coming weeks and months on these markets. Okay, so starting with a look back, it comes as no surprise, I think, and it was already mentioned also that we have quite a strong environment, definitely on equity markets. That was already the case for the last part of 2020. Well, from the middle of March actually, and we're off to a very good start in January and February as well. Just looking at these numbers here, the blue line is the global equity index. So that's up quite significantly since the lows that we touched upon the middle of March at the height of the COVID crisis. And we're off to a good start, which means a good 5% since the beginning of the year, which is quite impressive. That's more or less an average year on the equity market. So we're only 2 months in, and that's already the figure that we have. Also quite striking, especially for those of you that are familiar with bonds investing. Also, bonds did quite well for a long time, but they are now clearly struggling. And so we have a negative return on both government bonds as corporate bonds. Now, a bit of details perhaps on equity regions very quickly, so we have some time for Q&A after the presentations. But the one in the lead is Asia. China, clearly, first ones in the COVID crisis, first ones out as well, and that's what you see being translated here. And it's then followed by the US and the UK. Also, those countries hit quite harshly by the COVID crisis, but dealing with it remarkably well now and opening up their economies at a faster pace than, for example, Europe. And you could say that Europe is quite disappointing in tackling this crisis, and that's also what you notice if you look at performance of the stock market. Sector-wise, quite an interesting picture for us as investment strategists. We try to pick the right asset class, and within that asset class, we also try to pick the best performing sectors. What we saw in 2020 is that the clear winners of this COVID crisis were, for example, the technology sector. What we are now seeing is that as economies very slowly start to reopen, that you have sectors like energy enjoying the oil price that moves up, financials enjoying stronger economies and interest rates that go up, that these are starting to be picked up by investors and are now in the lead. Very defensive sectors like healthcare, like staples, like utilities, are left behind, and that's not what people are looking for at the moment. The atmosphere is very bullish, like we say, and then they go for the more aggressive plays. Speaking on commodities, that's also what we see there. Reopening economies means that the quest and the demand for commodities is growing, and that's what you notice when you see the oil price, but also the copper price, for example. Typical risk-off plays. When people start to worry about the future, they hide in gold very often. Very few people are doing that at the moment, and the gold price is actually down since the beginning of the year. Now, that brings us to the bond yields. I mentioned there that we were growing accustomed to very low interest rates and interest rates that moved lower day by day. That's what we saw for a number of years. That's also what we very clearly saw in 2019. 2020 was more or less stable, but now look at the dark blue line. That's the US interest rates. That's up. It's up and quite vigilantly. It's up another 10 basis points today. So things are moving very fast in what we would typically call a very boring bond market. It's not boring at all these days. Interest rates are up, and that's creating a very difficult environment for bonds investor. Imagine that you are a bond investor and these are the type of bonds that you can invest in. Well, that already illustrates how difficult it is. Nothing is in positive territory. Inflation-linked bonds were up till yesterday still positive, but they now also joined the negative club. And everything else is also negative, especially the longer durations. So the longer your duration, the more sensitive you are to rising interest rates, and that's what you clearly see here. The longer, the harder that is asset classes. So for bond investors, very difficult start of the year. And then last but not least, currencies also always quite important. We see finally, when you are working in trade or with companies in the UK, this will clearly be something that you've been confronted with in the last few years almost. The Brexit story is getting digested finally. We kept it with us for a very long time, and that's what you see on the British pound. It's starting to recover after being beaten up for a number of years. Other currencies, Japanese yen and Swiss franc, would typically be considered safe havens. That's similar to gold, for example, or defensive equity sectors. That's where people hide when there is a storm breaking out. That's clearly not the case at the moment, and these are left behind. So bottom line is we started off at quite a strong foot in 2021. It's risk on all the way, you could almost say. So quite important for us then is will this continue? Yes or no? And what is actually happening? Now there's a lot of elements always there that we need to take into account. So what I try to do is I try to bring them together here, starting with the obvious one out there is of course the COVID crisis. Definitely in Europe, we have a tendency to focus very much on the negative side, on the lockdowns that are being implemented, that are being prolonged, on people that are not being allowed to travel, on restaurants that are being closed. That is, of course, all very negative and very frustrating. But if you take a step back and you look at the figures, especially globally, this COVID crisis is getting under control. That's the good news. You can argue whether we are in a second or a third wave, but you cannot argue the figures that are coming down, and that are coming down quite significantly in large parts of the world. In the United States, I'm not that convinced that they handled this crisis very well, quite the opposite. But the vaccination speed is impressive. The same goes for the UK. It's really Europe that is struggling to get everything up to speed, but in the rest of the world, we are seeing a good and a positive evolution. So the number of cases is actually coming down, and is coming down at quite a strong pace. What is not yet coming down, and that's clearly something that you would expect in the weeks and the months ahead of us, is the lockdown measures. Governments are very cautious, especially on the new variants like the UK or the South African or even the Brazilian COVID variants, which are very contagious. That's clear so far. The good news is that the vaccines are working there, but the bad news is that they are very contagious, so that it's not that difficult to imagine that we have another pickup in this COVID crisis before we actually reach the summer. And that's what everybody is quite worried about, and that's also why we are only very slowly moving towards an unlocking of the economy. Here on this graph, you can see the lockdown measures, how they are being implemented. Most of them are still very strict. Oh, I've been working too long. Sorry about that. So most of them still very strict, and we are looking forward to these being relaxed, but we're not there yet. Not even in the United States, where despite very strong economic figures, we still have quite a big or significant part of the economy that is in lockdown or some shape form of lockdown. The vaccination speed then, that's pretty much where everything comes down to now. The COVID is there. The only thing to get this under control is to really move ahead with this vaccination and speed up the process. There's a few positive elements here, and that's definitely what markets are picking up and why they are looking through most of the COVID crisis. And that is coming from Israel. The results are very promising, as the bigger part of your population gets vaccinated, that the numbers drop quite significantly, and perhaps also more importantly, that also the new variants that are traveling around the world, you could say, are not impacting or not bringing new COVID negative COVID figures. So that's very promising as from Israel. They are really leading the way here on how you need to organize these things and how you need to organize them in a very efficient and very fast way. It's very much the UK and the United States that are showing the rest of the world how this needs to be done. Europe, I would almost say, like we've seen many times before, is as always also moving in the right direction, but is again doing that at a slower pace than you would hope for. Now, the combination of those elements, so first of all, the COVID crisis getting under control, but secondly, the lockdown measures that are still very much in place in most parts of the world, bring you an economic picture that is actually quite straightforward to explain. What we've seen in 2020, the first COVID wave, is that the world as such did not really understand what was going on. It very much was about safety first, and the whole economy was put in a lockdown, which obviously has a huge impact on your industry and also on your service sector. This graph shows you confidence indicators in these sectors, and they collapsed worldwide, as you would expect. As time progressed and as we started to understand how this virus works and how we are supposed to live with it, we saw that the industry part of the economy was reopened and was actually doing very well and continues to do very well. So if you have an economy that has two engines, the industry sector and the service sector, it's really firing on all cylinders on the industry side, and that you can consider very much worldwide. It's very much struggling and still has a strong handbrake on the service side. Service side, you could think of hotels, restaurants, the travel and the leisure industry. Big parts of that industry are still very much in lockdown, and you clearly see that their confidence is very low. If it's below 50, it typically shows at a shrinking economy, which is very much what is happening there. What you also see on this graph is that in the summer of 2020, when we moved for a short period in time towards a more open economy and also the service sector reopened, that you really had a strong shoot up in these confidence indicators. So that's the good news. Sectors are being hit hard, quite hard, definitely on the service side by these lockdown measures. But once the economy reopen, very quickly, people move back to business as usual. We are all very eager to start traveling again. We are all very eager to start visiting restaurants again. And that's what was quite promising in the summer of 2020. And that's what we would expect to happen as we progress through 2021. A lot of that has to do with very impressive budgetary stimulus that is being rolled out across the world. What you typically see in a recession is that your economy collapses and that you have a lot of victims, as in a lot of families, a lot of people out of a job, out of money, and confidence is impacted. This crisis has very much been treated like a health crisis, which it obviously is, And governments, together with central banks, you could say, are almost building a sort of bridge between the world before the COVID crisis and the world after the COVID crisis. So there's money being thrown at the problem, quite a lot of money, you could say. Especially in the US, it's very impressive. We are already at 3,000 billion, and we have another almost 2,000 billion plan being voted anytime soon now. So we are looking at figures that move up to 10 to 15% of GDP being spent this year and next year. That's quite impressive. Also in Europe, a lot of money is being thrown at a problem, but as typically happens in Europe, it's a lot slower. More people need to process it and need to approve it. That will all happen, but it just takes a longer while. And also the size of the program is impressive. Nonetheless, it's around 5% of GDP. It's somewhat less than what the US is planning. But it means that we are looking at this type of economic recovery figures. The red line is China. Like I said, first one in, first one's out. Very strict policy to deal with COVID. You don't really need to protest in China and say that you want your freedom back. That doesn't work very much or very well over there. If it's lockdown for everybody. And if it's necessary, the whole city goes in lockdown. And that's what you clearly see in a crisis like this. That works, especially from an economical point of view. That clearly works to keep this under control as quickly as possible. In the more Western countries, of course, this is less obvious to do. And you see that also in the economic growth figures. It fell, of course, quite significantly, and then the recovery pace is somewhat slower. The US is opening up their economies somewhat faster. Didn't close them as much as in the Eurozone. That's what you see on the light blue line. The dark blue line is then the Eurozone, where we really were hit slightly by the second wave at the end of 2020. So some call it a double dip. It was not that strongly, but nonetheless, it was quite an economic hit once again, and we are recovering from that pace now as we speak. It also means that China is already growing faster and has already reached a level higher than where they were before the crisis. The Eurozone, that will take a while, and we will probably only reach that somewhere next year, so 2021, 2022 even. Then oil, always important. Oil for a number of reasons. First of all, it's whether you like it or not, still a very important commodity for many parts of the economy. That's also why it reflects the way the economy is recovering quite well. And there we have to say that the current oil price is somewhat higher than we expected. It really shows that the economy, not that much in Europe, but definitely in China, is firing on all cylinders. And that also in the US, we are starting to see economies being opening up and demand picking up. So oil consumption is moving up. And then in the background, you have this price war basically going on between the OPEC countries that try to protect their old reign, and then the US shale producers, which are getting increasingly competitive and are starting to drill for oil more and more, and also starting to produce oil more and more. That is why in the long term, we basically have an oil price forecast which is around 55. So it's lower than where the current oil price is. We really think that we are seeing some overshooting at the moment. Now, the reason why oil is important is, as I mentioned, it's an important commodity, but also, and perhaps even more important, it's a very significant driver of inflation. Whether our lives are getting more expensive or not, if we are paying more for our petrol. That's a big driver in that. And as a reminder, I think somewhere last year, March, April, we had this strange phenomenon where the oil price or the futures actually moved into negative territory. There simply was too much oil. There was no demand, and the producers did not know what to do or where to deliver the oil that they had produced. And actually, I had to start paying people to get rid of the oil that they produced. We are now almost 12 months later in a very, very different ball game. Oil price is at $64 per barrel. So just calculating the effects on how much has the oil price risen from last year until now, that's already quite significant. That pushes the inflation figure up quite significantly, and that's very much what we are seeing now. Inflation figures are rising, and that means that interest rates are reacting to that and are also moving up. The big question, and it's definitely a strong theme in the market now, is how far will that go? If you really expect inflation to come back, then we still have some significant correction ahead of us on the bond side, I mean, because interest rates then will continue to rise. We don't really think that that's going to happen. We really see some structural elements in place why, first of all, the oil price will not significantly continue to rise. We do have some elements in place where in the coming weeks and months you have these year-on-year figures that will impact the inflation. But if you look through that and you have an oil price that remains relatively stable, the biggest remaining driver is the labor market. And on the labor market, it's very obvious, both in the US as in the Eurozone, that we still have a long way to go before we are actually starting to see a labor market that is getting into trouble and that really needs to start raising wages to get all the right people in the right jobs. And that's when you really start inflation to see coming through. So that's something that we don't really expect, and that in its sense is a very important element in monetary policy. Central banks are very clear these days on what their future policy looks like. If I can quote the Fed Governor Powell, they are not even thinking about changing their policy because there is some inflation figures or some inflationary pressure coming up. So central banks are very much saying we are looking at all the figures and what we are seeing is an economy that is recovering. We see some inflationary pressure coming to the markets, but that is based on once-off effects which will fade away in the coming months. So we are very much willing and very much convinced to keep our monetary policy very accommodative. We will not be raising interest rates anytime soon. These are the predictions here of KBC, but they are very much aligned with what the central banks are saying themselves. We are not expecting any rate hikes, not in the US, not in the Eurozone, not this year, not even next year. So that means lower interest rates for longer. You have some upward pressure on the longer bond sides, but even there we would expect that to remain relatively muted. So we are not going back to interest rates of 3-4% where we were not that long ago, definitely not in the US. We are quite convinced that this is a lower for longer environment, definitely in the Eurozone. In the Eurozone and also in the US, actually, not only do you have the policy rate, that is a tool, on top of that, you have quantitative easing. So central banks are printing money and are using that to keep interest rates under control. The Eurozone launched an additional program in the middle of the COVID crisis last year, the Pandemic Emergency Purchasing Program. That's just to give it the name because as we are moving out the COVID crisis pandemic, the plan remains in place. So the only thing that we would expect here is that perhaps they will change the name. but we very much expect this to remain in place simply because the central bank wants some growth, is fully supporting that, and is welcoming any sign of inflation that it can get. And that will remain limited. So as long as that is limited, they, in our view at least, will keep interest rates low, and that's very much what we see at the moment as well. Now, then next, a very important one, and that is explaining, I think, to a large extent, the upbeat sentiment on the financial markets, is corporate profits. Every quarter, companies report on their sales figures and their profits, of course. They are getting very careful in their forecasts. Companies typically don't really like to give forecasts because then, of course, they can disappoint. But nonetheless, they have to do it, so that's what they do. And the last earnings season, so that's Q4 of 2020, all these figures have now been reported, was actually quite impressive. We are in negative territory for the Eurozone. Earnings were 20% lower than the year before that. But in all other regions, we have positive earnings growth. So despite the COVID crisis and despite the lockdown measures, both in Japan and the US and most of the emerging markets, we really saw companies getting profitable again, and not only being profitable, having profits that are growing. And that really was something that was not expected. That was something that was expected for 2021, not so much for the last quarter of 2020. So the fact that they were already managing to be profitable in the last quarter of 2020, which was a quarter where we were still very much under lockdown, especially in US and the Eurozone, is quite promising for 2021. So the graph on the right-hand side shows you what we would expect for 2021 on profits. That is really quite impressive. We are going towards company profits being on average 30% higher than what they have published in 2020. And that is what markets are starting to discount. That's what creates this upbeat sentiment. Now, the only downside, of course, of all these higher equity prices is that we cannot consider equity markets to be cheap anymore. There's a very important element that you have to take into account here, and that is these corporate profits. Sometimes people calculate valuation based on what has been realized. No, 2020, the last quarter was somewhat better, but the first 3 quarters were very poor. 2020 as a year was a very difficult year for companies on the profit side. So if you calculate the current share price with what was realized in 2020, you end up with a very expensive price. If nonetheless you calculate the current share price with what is expected for 2021, things start to look already a lot more reasonable. We cannot call equity markets cheap, but they're certainly not expensive if you start to discount some of the promising outlooks that we have. That being said, we are in this type of environment which makes us a little bit nervous, as we do see some bubbles popping up left, right, and sometimes center as well. Bitcoin, to name one, it's quite a rally that is cryptocurrency is moving. GameStop is another example of how there's a lot of retail money looking at financial markets and trying to make additional profits. That is typically quite a speculative environment that very often in the past was a warning sign that markets were getting a bit overheated. On the overheated side, Tesla would be another one. It's very difficult to value a company like Tesla. So it's very much future dreams, possibilities, data assumptions that are being used to value that company. But if you look at valuation as such, based on earnings, that company is exceptionally expensive. And then green energy plays. Green energy is a very hot topic, has a lot of reasons why it should be a hot topic. Climate change is no laughing matter. It's a problem, and it's definitely a problem that needs to be tackled, and it will be one of those hot topic, sorry, no pun intended, in the coming years. But you clearly see that also there a lot of the retail money is flowing into, and that valuations have been driven to quite a big extent. If you then zoom in to this in a bit more detail, and you look at the different markets across the world, what we see is that the equity market in the US is not that cheap. You could call it expensive actually, and that's it. Japan, Eurozone, emerging markets, UK are actually valued at a normal level. Japan probably even somewhat cheaper than on average. So if you're talking about expensive markets, you're really looking at US. And if you're then looking at the US markets, what you really see is that you have a technology sector that performed very strongly under the COVID crisis, and that is actually supported by spectacular earnings growth. Companies in the technology sector are reporting quarter after quarter exceptionally strong earnings. So there you could actually even argue that they deserve to be somewhat more expensive, or that they deserve to be at a premium. And then last but not least, when we're talking valuations, people tend to focus on equities, but very often overlook other asset classes, where if you look at real estate, if you look at bonds, for example, you very often come to the same conclusion. It's also expensive. And I think the bottom line here is pretty much what we see is very aggressive central bank policy, very low interest rates. So to put it differently, money is cheap, and that basically triggers everything else to become more expensive. So are equities expensive? Yes, but everything else is also expensive. We are in this world where you have a lot of liquidity and a lot of money available, and that's what you see basically in most asset classes. So our challenge is to translate that into an investment strategy. To summarize, we see a economy that is actually holding up quite well. The summer of 2020 learned us that consumers are still very much willing to consume. So it's a matter of having these economies unlocked and keeping the COVID crisis under control, which we think is on the right track. On top of that, we have companies that adjusted remarkably well and fast to this new world. Definitely the industrial part of the economy that was already turning back to profitability in the last quarter of 2020, which makes 2021 a very promising year on that front. The oil price could ruin this if it shoots up a lot higher, but we don't expect that to happen. Quite the opposite. If it falls back or it stays at the current levels, we see no reason whatsoever for central banks to change their programs, so they will remain very supportive. On top of that, you have stimulus programs in most countries of the world, which are also supporting the economy. So that's all pointing towards risk on environment. The only thing that could keep you back from going very much into or full into equity markets is that a lot of the good news has already been discounted for. We have to be honest here, stock markets are not cheap anymore. In the US, you can even call them somewhat expensive. Certainly certain pockets are there. Another one definitely to keep an eye on is, of course, the COVID crisis. Things are starting to look up, but we definitely have not won that war yet. So still some months to go there. Which brings us to this type of asset class. We are overweight equities. That should come as no surprise, I hope. We are not fully overweight equities. What we would like to do is, if markets pull back, and they typically do after such a strong rally like we have seen, for whatever reason, then we would like to buy some additional. So it's a buying on the dip strategy, you could say. We are quite cautious on bonds, very low interest rates to start with, so there's very little to gain there. And definitely in the coming weeks and months, we would expect bond yields to move up. We have these inflationary figures that will surprise on the upside. We feel there's nothing to be too worried about, but that might create some pressure. Once we reach the summer, we think that will level off, and then probably interest rates can come down again. Within equities, the regions that we go for are very much Asia and the United States, and we fund that from Europe. We're not that impressed by the European economic recovery. On the sector side, it's also playing the recovery trade, as we call it. So materials, that's a typical commodity-related sector that benefits recovering economies. Industrials is the same. Consumer discretionary, I'll come back to that, is also one of these sectors. Financials, also very cyclical, so should enjoy and outperform in a reopening world. And then technology and communication, that's sectors that really very much were already performing quite well. We have the COVID crisis that gave those sectors an extra boost, and we think as a lot of the, for example, teleworking will become and stay part of this new post-COVID world that we're moving to. We are funding that out of the most defensive sectors that we have. So staples, that's food, healthcare, utilities, and real estate. That's where we take the money from. And then in bonds, it's very much looking for basis points. So we try to do what we can. It's a fight for every basis points there, and we pick up some in the corporate bond sphere and also in the emerging markets. Now a bit more detail on where we feel or where we have the strongest outperformance view. That's small caps in the Eurozone. So as I mentioned, we're quite cautious on the Eurozone, but the small caps we feel are the best play on these economies reopening. They're superior to the larger companies. Profitability is higher. Debts are very much lower, so they should really enjoy an economy that is reopening. Definitely, if you look at the Eurozone, it's the backbone of the economy. That's less the case in the US, where large caps are more dominating. But in the Eurozone, it's a lot more about smaller companies, and that has been going on for quite some time. So they tend to outperform. They definitely tend to outperform when markets are in a positive mood. That's what we expect. And additionally, it also gives our analysts an opportunity to outperform. If there's only a few analysts looking at a company, you can make a bigger difference than if you are analysts number 2000 looking at Apple or Microsoft. Probably all the other ones are seeing the same thing like you have been seeing. Consumer cyclicals, then, that's the sector that we're really pushing. A lot of that is linked to a reopening economy. So it's the retail sector. Shops that start to reopen should really benefit from that. The clothing sector, of course, a big element of that. Hotels, restaurants, travel, that's all part of that. And then the auto sector was also somewhat held back, although they were covered already quite nicely in the past few weeks. But overall, if you look at a lot of the sectors that we have, this one is positioned best to a reopening of the economies in the coming weeks. Then the trends funds, we have been playing that for quite some time, and we would like to continue to do so. Why? Because we really think this is about the future. It's about digitalization, medical technology, aging of our population, changing in consumer behavior. This has very little to do with COVID, I have to say. That's really about the future and how the world is moving and evolving into these new technologies mainly. What we did see is that COVID really boosted it. So a lot of the trends that were already happening, like digitalization, like technology and all the communication, trends that we were already witnessing, that was really speed up by COVID. You could almost say for these niche markets that was a huge experiment which was very successful, and there we do feel that a consumer from that point of view is a very straightforward creature. If it adds to my comfort, I will continue to do so. Of course, if something does not add to your comfort, we obviously will remove to our old ways, but a lot of these trends we feel are now just speed up and got a bit of a boost from the COVID crisis, and are very much still here to stay. Also here to stay is the water team, and I'm finishing up then. Is it's the blue gold that we would call it. We're not the only ones. A lot of people call it like that. The investment case is quite strong, and there's more people in the world that already makes the water consumption or the demand for water higher. On top of that, as we not only see a growing population globally, we also see a population that is getting more and more wealthier. There's a big part of the emerging markets that are moving towards the more wealthier part, or are starting to make more money. And as you get more and more, or start to earn more and more, have a higher wage, your pattern of spending that also changes, and the way you live also changes, and that always includes more water. So there's a demand for water because there's more people, and the people that are here or that are living on the planet are also consuming more water. So that makes that the demand for water is growing exponentially, which basically supports this niche market. There's companies investing in infrastructure. There's companies coming up with new technologies to make seawater drinkable, for example. That is here to stay, and that will stay with us for quite a long time. It's performing nicely, and we don't see any reason why it should start to behave differently. Medical technology, very similar. It's basically the aging part of the world. As people are getting older and living longer, the request for medical support grows. That is also a trend that is exponentially, and that is also a trend that will not change anytime soon. So that we're keeping that one in place as well. And then to finalize and move to the Q&A, just to give you a flavor on how difficult it is for a bond manager to make any performance. This is the yields that we can currently earn on our bonds. So if you buy Eurozone government bonds, 3 to 5 year, that actually costs you money. So you really have to move to the right-hand side within the fixed income world, and then you're moving towards corporate bonds, emerging market bonds. Also, the high yield spectrum is offering somewhat more yield, and that's where we are trying to come up with some additional basis points. But the bottom line is very much difficult. This is some of the main European countries. Like you can see, it all starts in negative territory, and you really have to commit your investment to 6 year or even longer when you want to start to earn a few basis points. When you stay below that, it's better to keep your money in cash. Bonds are not yielding anything, and very often, definitely in the Eurozone, it's costing money. So corporate bonds, that's the spread. It's 80 basis points more than what you can earn on a German bond, for example. 80 basis points, you probably consider that a joke. I share that view. It's very difficult, but it just shows you how difficult the fixed income world has become. And this is the reality that we are working in. So 80 basis points for a bond investor, that's very, very good these days. And that's where we aim at and where we invest a big part of our fixed income portfolio these days. And that's it from my side. I hope you learn something. If you have any questions on that, feel free to ask.
Very well. Thank you very much, Tom, for this, I must say, very interesting and insightful view on the markets, how they have behaved, why they have behaved as they have behaved, and how you look at markets going to behave going forward, taking into account all the inputs like the COVID lockdowns being unlocked and so forth and so on, also giving us some insight in some sectors, themes, and asset classes to invest in. Now, I invite everybody who still has a question to put it in the chat. Feel free to do so. Tom, we have 3 questions pending. I will read them, and of course, I give you the floor to answer. First question we have is, when do you forecast, because you were saying it's going to be longer for lower, central bankers were quite clear in that change short-term policies and would also try to keep under control even the longer interest rate part of the curve. Now, nonetheless, when do you then expect the first interest rate hikes from both ECB and the US Central Bank?
It's a very long time before we actually see that. The reason for that is, first of all, central banks are very, very clear that they have a dual mandate. The Fed is clear about that, the ECB less, but they have a similar policy, which is making sure that the labor market returns to its normal behavior. And then secondly, inflation target of around 2%. Both of them are very far out. They will happen first in the US and secondly in the Eurozone. Another element is the policy rate is the instrument that we look most upon when looking at central banks and the policy that they are following. But there's a lot of other tools in place as well these days. So they are really printing money and using that money to keep yield curves under control. So really answering your question on when do you expect a rate hike from the Fed and from the ECB, that would definitely be late 2022 for the Fed and 2023 for the ECB, which is a long way out. What will be important for interest rate markets and bond investors is, well, definitely that hike, but the period leading up to that, they will already start to scale down their quantitative easing. So you could also consider less money printing as some sort of a policy adjustment and some sort of an interest rate hike. So really the hike as such, I would say late 2022, maybe even 2023, and the ECB being 1 year later than the Fed. The period leading up to that, very similar. We will see the Fed moving first, then the ECB, and that will be about scaling down their supportive quantitative easing.
Okay. Second question, Tom, is, we're of course, and you indicated a couple of sectors like the leisure industry, the tourist industry, clothing shops that should benefit from the opening up of the economies, the opening up of the lockdowns going forward. On the other hand, what a positive sign. That's the opening up of the economies. On the other hand, what we see today is we see a lot of money, and you have mentioned it, a lot of money is being poured into the system to help companies over this crisis. Point one. Point two, on top of that, we saw and we still see quite some support in many countries of loan moratoriums, which basically give a benefit is the wrong word, but they give a relaxation to companies in these difficult times to pause, to put the pause button on their loan repayments. Now, despite opening up of the economy, once those two supporting factors, the pouring in of money and the stopping of loan moratoriums, once those would cease to happen, what do you see as impact of those measures being stopped on companies and the economy? Because we haven't seen bankruptcies. How will that evolve?
It's even illegal to go bankrupt these days. A lot of companies cannot file for bankruptcy even. And that is also perhaps the introduction of the answer, because we really think that the scaling back of these supportive measures will be very, very gradual. We will see a reopening of the economy going hand in hand with supportive measures being reduced quite slowly. If they really would scale it back drastically, as in we open up the economy tomorrow and all subsidies stop as well, that would be a disaster. It would definitely be a disaster for niche markets like the leisure sector, like hotels and restaurants and bars, for example. That's definitely the case, and that's what governments absolutely want to avoid. For stock markets and financial markets, that's a bit ironically perhaps less of an issue, as they are not that heavily represented on stock market, but they are very important for governments because they are a very important provider of jobs. So if you want to protect your job market, you have to protect these sectors, and that's very much what they are doing, and that's what we would expect them to do. That is also why, for example, we invest in high yield bonds. To give you some more insight on that, high yield bonds, it sounds sexy, high yield, but it really is junk. So if you look at the ratings from the poorer ratings, you really start to call them high yields. That's the type of bonds that you want for higher yields, but you want to be careful for bankruptcies. If we would be convinced that we are entering a period of economies being reopened, but at the same time subsidiary measures being scaled down at a very heavy pace, we would not do that, because that's the type of companies that will fall out. So we very much expect this to continue. That's what governments absolutely want, and that's also what central banks point at every time they refer to the labor market, and the labor market needs to return to its originally strengths. And people are very, very, very well aware of that. And that is, in fact, the big difference between this crisis and a previous crisis. In previous crises, you did not have so much measures, which meant that these companies went bankrupt. And then you have a secondary round of effects. Companies go bankrupt, which means that people are losing their jobs and your consumers are also getting under pressure. That's what they want to avoid at all costs now. That is what they are doing quite successfully. And that is why we look at the financial markets then. We have the strongest correction in March and the strongest recovery in April and June, followed by that. Once the financial market was convinced that this is the way forward, it basically recovered to the level it was before.
Next question, Tom. Yeah, you touched upon it, cryptocurrency. You touched upon one of them, the most famous one, of course, Bitcoin. How do you see the trend in 2021?
Very cautious on cryptocurrencies. I think there's a few elements there. First of all, The positive element is that cryptocurrencies and then very often the blockchain technology behind it is very promising. And will definitely shape the way we live going forward. So we will do a lot of the things that we do more digitally. We will pay a lot more using computers, and I would not be surprised that cryptocurrencies become part of our currency spectrum, so to say. So the technology behind that, I get. I think it looks promising. Is Bitcoin or any of these cryptocurrencies a good investment? My answer there would be no. And the reason for that is I know that the stock market is contradicting me on this one. But the reason for that is that, first of all, how do you value these things? There's nothing behind it. You buy a Bitcoin today and you hope that somebody will pay more for it tomorrow. It's not that all of a sudden there's a company behind it that has a very powerful product, or there's a government behind it that has economic growth behind it. Cryptocurrencies, there's only so much there. That's part of their strength. Even they are not making any more, and you hope that it will be valued more tomorrow, and that somebody else might buy it of you. And that brings me to the second element. The reason why that should be valued more tomorrow is because there is value in there. And the only value that a cryptocurrency can have for me is the fact that it's considered a currency. And that's not happening. There's very few companies that start to work with Bitcoin. There's a lot of companies that want to work with cryptocurrencies, but it's very difficult for them because what's the value of the Bitcoin? You can sell a product in Bitcoin, and how much is that worth? That a currency needs to have a stability element in it, and that's why, for example, the dollar is one of the biggest currencies in the world. Why the Eurozone was as a project that still needs a lot of work, but the euro as a currency brought stability to the region. If you want a currency to be used by a lot of people, you need it to be stable, and it's not stable at all. So that's why I think from a technology point of view, yes, absolutely promising. From a currency point of view, it's just too volatile to be used on a large scale, and as long as that is not happening, it's very difficult to build a positive case on that. And it's for me, it's to be brought back to a lot of speculation that we are currently seeing on the market by retail investors that sometimes, because of the lockdown measures, are sitting at home and are really trying to make an extra dollar because it's very often US led, and that's what you see. They are buying green energy type of investments. They are buying bitcoins. They are buying Tesla. All these things that are going up or are continuing to go up. And when will that stop? Very difficult to say. Well, impossible to say. But this will end in tears at a certain stage. So
Okay.
are we investing in cryptocurrencies? No. Are we
Okay.
investing in technology, communication, these type of trends? Absolutely.
Very well. Last question I have in the chat, Tom. That is, well, of course, we have Biden entering the leadership of the US, of course. How do you see the tensions that, of course, were built up in the past between the US and China? And I remember very well some time ago the two economic or political elements that we were talking about as potential impacting factors in the market was Brexit and the tensions, the trademark tensions, China-US. Brexit, as you said, is somehow getting consumed. How do you see China-US evolving?
I basically would expect that to continue. You're absolutely right. It was a very dominating element under the Trump presidency. I think the way it will go on now might be more diplomatical. Biden does not really have the same tweeter behavior like Trump has. But the underlying tensions will remain, and will remain for quite some time, because this is not about trade. This is about technology leadership. And who will be the leader on the technology front for the next few decades? Will it be China or will it be the US? And that's very much what is going on underneath trade tensions. And that has not changed. Biden has a different style than Trump, but the tensions are still there and will remain there for quite some time. And in fact, if you look at the US political world, they definitely don't all agree with what Trump has done or not done. But most of them do agree with the way he approached China. Also, the Democrats, a lot of the Democrats were quite happy to have somebody in the White House that was taking on China. And he had his own way of doing that. And that will be different under Biden, but it will continue. I'm pretty convinced about that. So the style will change, but the tensions will definitely remain. Now, that being said, it's the two big powers in the world that also need each other. So the tensions will be there from time to time. That will spook the market for sure. It will also shape the way we look at the world in the coming years, and definitely how the technology evolution will continue. But I don't expect one country to be a clear winner. They both have these niche markets. Very often they are doing similar things. The one goes faster than the other one in a certain niche, and then another niche, it's more the other country. So that continues, but a full-out war, so to say, that's not beneficially for nor China nor the US. And that is also why Trump never went that far. And that I would expect to continue. But
Okay.
the bottom line is, I think there is one element in the whole Trump presidency, that Biden is quite happy with, and that is actually how Trump dealt with China. And he can now continue on that page.
Very well, Tom. Tom, we have exhausted the questions that were there. We are also 7:10, so we have exhausted our time as well. I would want to close with, first of all, thanking you, Tom, for being present here with us today.
You're very welcome.
I think it was a very interesting, insightful presentation, where probably we will all reflect upon a bit more even after today's presentation. Point one. Point two, I would like to thank everybody present today in the discussion. Thank you for your participation. As I said, last but not least, I would like to thank both the members of and the management of the BBL, the Bulgarian, Belgian, Luxembourg Business Club, and AHK for the co-organization of this event. I hope it was valuable to all of you, and as said, the presentation of Tom will be made available to all the participants. And obviously, Tom will be happy if there would be questions coming after the event still today to come back to you on that one. And let me then conclude by wishing you all three things. Good health in the upcoming weeks, months, and time to come. 2, a very nice reminder and remainder of your evening. And 3, very wise investment decisions going forward based on what you have heard today. Thank you very much, everybody, and I wish you a wonderful evening.
Thank you. Bye-bye.
Bye-bye.